Hello, welcome back to the show. So in today's video, I'll be talking about the greatest super investor buys this quarter. So in today's video, we'll be covering a few things. We'll be covering the compounders bought by all these super investors, why Google is at big risk, as well as some questions that you guys have left me in the comment section below. So let's talk about the first super investor. This investor is none other than Warren Buffett, the greatest investor of all time. So if you were to look into his portfolio over the last quarter or so, he hasn't added significantly to any of his positions. I mean, the largest add that he made was Constellation Brands, which was around 0.4% of his portfolio. So it wasn't that big of an add as well. He's currently sitting on a very large cash pile, and the stocks that he added included Constellation Brands, CV, Oxy, and Pool Corp, as well as Domino's. So Pool Corp is one that is intriguing to me. He's been adding to his position almost for the past 3 quarters already. And for Pool Corp, what they do is they are monopoly in your pool space. So if you need to manufacture the pools, you need Pool Corp. If you need the chemicals to maintain your pools, you need Pool Corp. If you need the pumps for your pools as well, you need to go through Pool Corp. So Pool Corp over here is quite interesting to me because they own a large market share in your pool space over here. But the problem with the business is cyclical, the business is subject to economic environment, and they likely over-earned after COVID. So now the earnings are normalizing. So for Pool Corp over here, it is one that is intriguing, and Warren Buffett has been adding to it as well. Next super investor is Seth Klarman. So Seth Klarman over here, he is a value investor at heart. And for his portfolio over here, these were some of the significant adds that he had this quarter. So he added Google, he added QSR, he added Dollar General as well, and then he reduced his stake in this company called Wiltis Tower Watson. Not too sure what that company is, probably some deep value play, but I agree with the Google ad, not so much the QSR ad. And Dollar General as well, he's been buying this one since $60, so likely he has already had a massive gain in this position over here. So this is Seth Klarman's notable ad. He added QSR, Restaurant Brands International. So QSR, what they own is they own Burger Kings, they own Tim Hortons, and they own Popeyes as well. So it's a fast food company, there's not much of a moat for it. And for this company over here, it's simply a deep value play and a relative valuation play. So if you have to look at all the different other food companies, all the different other food chains, the price to earnings ratio is likely a lot higher. And when Seth Klarman started adding to this position, the company was trading at around a 17 times earnings. So a 17 times earnings for Restaurant Brands over here as compared to a McDonald's that was trading at around 25 times earnings, and a Chipotle that was trading at 40 times earnings. He saw a discrepancy in there and he added to this position over here. So for Restaurant Brands over here, I don't think it's an extremely wide moat company, so I won't be adding to this one. But if you're a deep value investor looking to find value somewhere, then this company is one that you could possibly look at. Next super investor is Terry Smith. So Terry Smith over the past 10 years has delivered around 183% returns, and he has been underperforming in recent years. So in the start of the 2010s or so, he was outperforming the markets by a significant margin. But over the past few years or so, his performance hasn't caught up to the markets yet. So for Terry Smith over here, he's known for this metric over here, which is your return on capital employed. So what Terry Smith aims to do is he tries to position his portfolio so that all the positions in his portfolio are companies with high ROCE. So if you're to look at the past 10 years or so, his ROCE for all his companies is around 28 to 32%, whereas the S&P 500 is around at 18%, and then the FTSE is around 17%. So he tries as much as possible to aim for companies with high ROCE, which is what I aim to do as well, because high ROCE means the company is able to reinvest its profits into its business to earn incremental profits over time, which is normally what you want for your companies over here. So for Terry Smith over here, here are some of his trades this quarter. So he's been selling out of every single one of his positions. The small selling is likely due to redemptions that are being made on his fund, simply because of the underperformance of his fund. But for the big positions like Meta, Microsoft, I don't agree with selling all of these core positions. Meta is an extremely high quality business, same for Microsoft, same for Visa, same for ADP as well. All these positions, they are extremely high quality, and I'm not sure why he's selling all these positions over here. Next super investor is Dev Kantesaria. So Dev Kantesaria is an incredibly high quality investor. His investment philosophy and his investment methodology is one of the highest and the highest quality out there. So for Dev Kantesaria over here, he's a super investor that does minimal activity. So if you have to look at last quarter itself in Q1, he basically only trimmed 2% of his FICO position, and then he trimmed a quarter of his Intuit position. So he hasn't done much this quarter as well. And this is what I admire about super investors like him. Super investors like him, they have minimal activity, they don't trade in and out of their positions, and they really go and hold their core positions and allow them to compound intrinsic value over time, which is what I want to do in my portfolio as well. Next super investor is Bill Ackman. So Bill Ackman over the past 10 years achieved around 125% returns. So for Bill Ackman over here, he has an incredible mindset. So at one point, he was almost bankrupt. So when he was fighting with the other super investor, and he almost went bankrupt, and he was dealing with a divorce at the same time as well. So Bill Ackman is someone that I really respect. his investment methodology is not one that I follow, but his investment philosophy as well as his mindset is one of the highest quality ones out there. So for Bill Ackman over here, he made one notable buy. So he bought Uber. He bought around 18% of his portfolio in Uber, and then he sold out of his Nike position over here. So for Bill Ackman over here, what he did with his Nike position is he sold it and then he converted it to Leaps. So he took the proceeds and then he added it to Uber over here. So for Uber over here, he bought it around $60 to $70 a share, and currently now it's around $90. So he has already had a massive paper gain on that. But for Uber over here, I think it is a company that is simply trading at too high a valuation. Same for Brookfield over here. Brookfield is an asset manager, and typically for asset managers, they are highly levered. So same thing for Brookfield over here. It's a company that is highly levered. Of course, it is trading at a discount compared to its book value, but what if its book value is inflated as well? So they reduced their position in Chipotle. This is one that I agree with as well. Chipotle is currently trading at a high valuation and the growth is slowing as well. And then they reduced their position in Google as well, and then Hilton Worldwide as well. So next super investor is David Tepper. So in the past 10 years, he's achieved a return of around 200%. So in the past 5 years, he has also received a return of around 200%. So he's a massive China bull, and in the recent years or so, he has outperformed the markets by a very large margin. So this is what David Tepper did in the last quarter. He exited out of a lot of his Chinese positions. So his Papa position is 20% of his portfolio. Pinduoduo is around 10% of his portfolio. Amazon is around 8% of his portfolio. He converted some of these gains into shorts to short the market, and he likely exited it in Q2 when the markets rebounded. So it was a very good trade on his part. But again, for this super investor over here, it is clearly too much activity in one single quarter. This is not what a normal investor can do. Only all the super investors with a massive hedge fund can do all this trading over here. So for a normal investor, I don't think David Tepper's activity can be replicable. So for me, this is too much activity over here, although I do agree with some of his buys. He has made some trades as well. He's been selling out of his core positions like Microsoft, some Amazon as well as some of his Chinese positions. Next super investor is Chris Hohn. Chris Hohn is an incredible investor, and this is what he said in his interview over here. He said that competition is risk, network effects is the greatest moat, and proprietary information as well as recurring revenue is important when it comes to owning a business. So this is Chris Hohn's performance over the past 10 years. He has outperformed the markets by a large margin, achieving a 244% gain as compared to the S&P 500, which returned around 195%. So Chris Hohn over here is a super investor that I respect as well. His portfolio is filled with compounding machines. So if you were to look at his portfolio activity this quarter as well, he trimmed a lot of his Google. So he trimmed 32% of his GOOGL position. He trimmed around 16% of his GOG position, and he sold out some of Canadian National Railway. He added heavily into Microsoft as well, which has paid off already, and he still added to GE. So GE is the company that sells your defense airplane engines over here, and he basically bought at the bottom for GE. So GE is a position that has massively paid off for him. I believe it has 3x since he started adding to this position over here. So this is what Chris Hohn said about his Google position and why he thinks Google is one of the highest risk stock in his portfolio today.
If it's free, yeah.
What about the other tech companies?
We have a position in Alphabet, and which is maybe our most risky investment, where they're clearly the company. It's just one of our smallest investments. As a result, it's and where we have some level of protection because there are businesses like YouTube and their cloud business, which represent half the market cap today, and their cash and other things. So it isn't all search, but search is critical. And so can they out innovate competition? Yeah, there's a risk of search fragmenting, as competitors come in and try to, but it's a question mark. Yeah, we don't think so. We think they have a lot of advantages of their data to have to offer higher quality search results, and but competition is increasing.
Talking of which, how do you think AI will change the investment landscape here?
It's going to increase disruption in ways we can't even predict, but there are things like call centers will all go bankrupt, and another segment is Indian outsourcing companies, who do coding and things like that. Demand for those services could collapse because AI can do coding, with half the people. Yeah.
So this is what Chris Hohn has said about Google. So he thinks Alphabet is the most risky investment in his portfolio today. So Dev Kantesaria has previously said that he doesn't know what search will look like in 10 years as well. And there's disruption risk when it comes to investing in Google. So Chris Hohn is saying the same thing as well. He's saying that Google search could be disrupted as well. And so when these respectable investors are saying all these things, it's time to reduce the confirmation bias as well. And for Chris Hohn over here, I agree with him. Google search is currently facing disruption. And if Google is unable to, number one, innovate or pivot out of Google search, then you could see a collapse in this business over here. But I still think the company is still undervalued. And so for me, I haven't been trimming out of this position. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first question is, what do you think of the strategy of buying shares of top 2 companies in the industry? For example, I have Visa and MasterCard for fintech, Home Depot and Lowe's for hardware retail, Exxon, CVX for energy and healthcare insurance. I have United Health and Elevance. So for me, I think there are a lot of industries that are non-investable. So for example, your retail side of your business, they're normally not very investable because there's too much competition in the space. Same for companies in pharmaceuticals, sometimes in healthcare insurance as well. Although I think United Health is significantly undervalued at this price. So for me, I don't think this is a strategy that I'll take. Investing in the highest quality industry is normally the approach that you want to take, not investing in commoditized industries like your energy, like retail that faces a lot of competition, and healthcare which faces a lot of regulatory problems over here. I think the better approach will be to just invest in the highest quality industries. Next question over here, always looking forward to your informative sharing. Possible to cover Meli and CrowdStrike as long-term propositions in a future video. So Meli is a company that I've looked at. The company is growing rapidly, so it's in your South America portion. So what they do is they are a fusion of Amazon and a fintech company as well. They have the banking portion of their business as well as the retail side of the business, the online retail side. So for Mercado Libre over here, I think it's a company that is high growing, high quality for sure. If you to look at the fundamentals itself, it's growing quite rapidly. But the two things that I can't wrap my head around is this. So number one, I can't understand the currency risk of the company. So I believe the company does a lot of its operations in Brazil, in Argentina, all these different South American countries. And so there could be some form of currency risk when your currency depreciates in your Brazil and your Argentina as well. So they could report lower earnings if those currency depreciates and if they continue selling in those currencies over here. And for Meli over here, they have a banking portion as well, the fintech portion. That portion has some form of credit risk as well, which is what I don't like. That's why I haven't been investing in the banks. So for Meli over here, it is a company that is simply out of my circle of competence. It's a company that is outside of the US, so I don't think I'll be looking into this one. I think the better alternative is simply just to invest in Amazon. As for CrowdStrike over here, it's a company that is high quality as well, but the problem with the business itself is the stock is trading at too high a valuation. And until the valuation comes down where it is sort of reasonable, I don't think I'll be investing into this one. This one is being treated like a Palantir stock already. It's running without its fundamentals going up. I mean, the fundamentals has been going up quite steadily over the past few years, but for a company to trade at such a high price to sales ratio, and one day you just don't know when, the stock price could come back down to meet its fundamentals itself. So for me, I don't think CrowdStrike is one that you should be investing in right now. It's a company that is trading at too high a premium, too high a price. Last question over here, I would like to ask for your opinions on Xiaomi. So for Xiaomi over here, what they do is they are simply like an Apple in China itself. But if you have to look at the fundamentals and the valuation for Xiaomi, the company is trading at a high valuation and the fundamentals are not keeping up to it. So currently, I believe Xiaomi is trading at a price to earnings ratio of around a 45 times. And for the fundamentals itself, unless you believe the China consumer can just continually recover from here, I don't think investing into a Chinese firm like Xiaomi is very desirable. In fact, I think a better alternative in China is simply just to invest in Alibaba. Alibaba holds the greatest market share in your Chinese retail market, and they have other businesses going for it as well, and it is one that is riding on this AI tailwind over here. So for me, I think a better alternative in China is simply just to invest in Alibaba. It is one that I'm looking at as well. So I don't think Xiaomi is one that I'll be looking at. It is trading at too high valuation for me, and the valuation itself doesn't really justify the price. I hope you guys have found this one useful and invest safe.